Hey, welcome back to Insurance Test Help. We are working on the insurance exam today, and I'm doing a video on some general terms, whether you're taking life and health, just life, P&C, doesn't matter. Most of these are going to be on your exam, so they're all important to know, regardless of which exam you're taking. It's kind of like just nailing down a lot of the definitions, so let's get started. This is what most of us think insurance is, something that protects us from losing our money. You pay money to your insurance company to cover you in case something bad happens. That is what insurance is, but for your exam, they're going to want you to know a little bit different definition. So for your exam, insurance is the transfer of risk. You pay your premium to transfer your risk of something bad happening to the insurance company to protect you from it. So for your exam, remember, insurance is the transfer of risk. Okay, getting right into it. What's risk? Risk is the uncertainty of loss. So risk is the possibility that something could happen to you. We all know what risky behavior is, right? So risky behavior can cause something bad to happen. So risk is basically the uncertainty of loss. You need to know that for your insurance exam. Probably going to be on there. So every single thing on this list has a really high probability of being on your exam, if not a for sure. So make sure you know everything on here. And if this is your first time going through this video, maybe go through it again at the end just to kind of make sure that you're really ready for it. So two kinds of risk: pure risk, which is the chance of loss. There is no possibility of gain. And then there is speculative risk. Speculative risk, I like to think about gambling or the stock market. You could win or you could lose. Speculative risk is not insurable. Only pure risk is insurable. And I think that will be the question, asking you which of these types of risks are insurable. And the answer is going to be pure risk, only the possibility of loss. The law of large numbers. So this is insurance principle. The law of large numbers says that the more data you have for more policyholders, the more accurate the prediction of losses. So if you think about a neighborhood, like my house maybe has a risk of hail. My neighborhood, they can get a better predictor on what the risk of hail is for my neighborhood, and they can certainly get a better idea on what the risk of hail is for several neighborhoods in the same area, right? So you can tell if an area is high wildfire, high hail, based on the data. So the more data, the more accurate the prediction. That is the basics of the law of large numbers. Okay, the concept of indemnity, 100%. This is on your exam. Indemnity is a principle of insurance that aims to restore you to the position you were before the loss. So it makes you whole. So it provides you like repairing your car, getting your health back in shape. It provides you with getting, if your house had a kitchen fire, rebuilding the kitchen just like it was, same countertop, same flooring, right? So it's restoring your position. So making you whole again, not making you more whole. You don't profit from a loss, right? But you're not supposed to take a hit for a loss either. You're supposed to just be made whole. So the question's probably going to be about being 100% whole or making a profit. So just know that indemnity is about putting Humpty Dumpty back together again how he was, not making Humpty Dumpty better than he was. Insurable interest. So insurable interest says that you would suffer a loss if you would suffer financially or in your family if you had a loss. So for property and casualty, that's really a financial thing. For life and health, it also extends to blood. So someone dies, you're going to obviously suffer financial loss, but also a loss of a relative, right? If your husband or your wife died. If this is car insurance, your car getting destroyed is going to affect you because you may have a car loan that you still need to pay off. You don't have a car to drive to work anymore, so you are suffering a financial loss. Something you own or something that's in your family, you normally have an insurable interest in. I cannot insure my neighbor's house because if my neighbor's house burns down, other than like it being an eyesore or maybe, it's spreading, which would be awful. I don't have an insurable interest in my neighbor's home. If it burns down and they're homeless, it's sad, but it doesn't affect me financially. So I can't insure that myself. They insure it. They have the mortgage. My home, however, I have a mortgage on that I have to pay. I would be homeless. So I would need to insure my own property, my own home, my own family, things like that. So that is what insurable interest is. You have to have the possibility of suffering a loss in order to have insurable interest on something. Okay, aleatory. Aleatory is an unequal exchange of values. You pay a very small premium compared to the possibility of the insurance company paying a very large payment if you had a loss. So I know your premiums seem high, but the $200 you're paying for life insurance, the $100 you're paying a month for your car insurance are very small compared to if your car was completely destroyed, or if you had a catastrophic loss in your car where, say, you killed someone, you hit a pedestrian or something. Insurance company's paying a lot of money for you, and your $100 really didn't make a dent, right? If your house burned completely down, the $400,000 that they're going to pay for your house is very large compared to the very small amount that you are paying in premiums. So yeah, you're paying $2,500 a year in premiums, but think of how many years you'd have to save that up for to come anywhere near paying off your house. So that is what aleatory is. Is an unequal exchange of values. You pay a very small premium for a very large possible payout in the event of a loss. And this will be on your exam. Unilateral, just like all insurance contracts are aleatory, all insurance contracts are unilateral. So in a unilateral contract, only the insurance company makes a promise to perform. You do not make any promise to perform. You just pay your premiums. If you have a loss, they are promising to cover you in the event of a loss. That's what makes a unilateral contract. It is only the insurer making a promise to perform. All insurance contracts are also conditional. So in order to get an insurance contract, there are certain conditions. Some of those conditions are that you pay your premiums. Some of them are a little bit more complicated, that you keep your property in good repair and that you notify the insurance company of changes in certain things. So all insurance contracts are conditional, and there's certain conditions you have to meet. All insurance contracts are contracts of adhesion. That means the insurance company writes the term of the contract and you either take it or you leave it. You don't like it, you don't get to negotiate all the terms. It's basically, here it is, take it or leave it. So that is a contract of adhesion. Only one side writes the terms of the contract. It's going to be the insurer, and you take it on a take it or leave it basis. Adverse selection. So this is another insurance kind of term. More claims, people who have more claims tend to buy more insurance. So people that like to go to the doctor a lot usually have really good medical insurance. People who tend to use their insurance have a lot of it. So people that tend to lose their stuff, they all have a personal articles policy rolling around for all of their jewelry and their laptop and their bicycle and their saddle and their watch and literally everything you could possibly imagine, because they lose stuff a lot. So those people have the law of adverse selection is that people that tend to make a lot of claims tend to buy a lot of insurance. And those are kind of the people that insurance companies generally don't want, right? Like if you have a house and you make a claim every single year, eventually you're going to get canceled because they don't want to just keep paying thousands and thousands and thousands of dollars when that's really not profitable. So that's sort of the rule of adverse selection. Subrogation, I think this is going to be on every insurance exam you could possibly find. You're also going to use it a lot in your insurance career. Subrogation is where you are injured by a third party and the insurance company sues the third party to recover. So, for example, somebody from company A hit you, it's their fault, but you didn't have you didn't want to file with their insurance company, which really would be the smartest thing to do, but you filed with your own insurance company, then your insurance company would go and sue them to recover the expense that they paid to fix your vehicle, your house, your life, your health, whatever it was. They would sue to recover that and also sue potentially for your deductible. So that is subrogation. So basically it is your insurance company recovering their losses that they paid to you from a third party. Okay, a binder. A binder is basically your temporary policy. When you give somebody buys insurance from you, you're an agent, you give them a binder. That is their temporary policy until the actual policy is issued. The actual policy doesn't come till the whole thing goes through underwriting. But in a lot of insurance, you can give someone a binder, which is temporary insurance for 30 days, short periods of time until that policy is issued. Okay, an exposure. An exposure is the risk of loss faced by you. So it is the possibility of loss caused by something. So a teenager driving your car is an exposure because they're, more dangerous drivers. But you driving your car is also an exposure. Your husband driving your car is also an exposure. Living in certain neighborhoods can be an exposure just because they're higher crime or they have more traffic. So and in life insurance and health insurance, the exposures are things like smoking increases your possibilities, right? So they're things that can make it more likely to have a claim and your risk, more chances of risk. Okay, deductibles. Deductibles are on almost every insurance policy, regardless of what kind of test you're taking. So deductibles are basically the amount you pay first before the insurance company kicks in. So if you had a $5,000 claim, you have a $1,000 deductible. The insurance company is going to pay $4,000. You're going to pay the first $1,000 and then they're going to kick in and pay the rest. Okay, the parts of the insurance policy. I like to use the acronym DICE: declarations, insuring agreement, conditions, exclusions. There are going to be a whole bunch of questions on what part of the insurance policy contains this or that or the other thing. We have a whole video that goes over the parts of the insurance policy because it is that important. There will be several questions on what one contains the insurance terms, which one contains the conditions, which one contains your address or your name. So make sure you know all of the parts of the insurance policy and what all of them are. And we have a special video for that if you don't already know. All right, parts of the contract. There are 4 parts of the contract. Starts with offer and acceptance. That is your first part. The offer is your writing your application to the insurance company. Acceptance is the underwriter accepting it. Consideration is on your behalf. Each side has to make consideration. On your behalf, consideration is you paying your premiums. On the part of the insurance company, consideration is their promise to pay in the event of a claim. Legal purpose is pretty easy. You can't do contracts for illegal things. It has to have a legal purpose. And competent parties means you have to be competent and a legal adult to sign a contract. For the exam, I think they're going to focus on 2 things, the consideration and competent parties. Consideration, again, is you paying the premium. That is your part of the consideration. And then the insurance company is them promising to pay. For competent parties, you can't have dementia, you can't be under the influence of drugs or alcohol, and you cannot be a minor. I think the question on the exam for this one is going to be all of these can sign a contract except, and then the except person will either be like a 16-year-old child prodigy or a person who's high or grandma with dementia. There'll be, I kind of feel like they're going to use that tricky except question thing to screw you up a little bit on this one. But as long as you know you can't be a minor, you can't be under the influence of anything, and you cannot have dementia, you'll be all set. Another big part of your definitions and things you need to know in insurance terms is going to be all the prohibited acts. So these are things that you cannot do, churning, twisting, misrepresentation. So let's break them down. Discrimination. You cannot give unfair and unequal treatment to insureds with similar characteristics. For example, you cannot charge higher rates or deny coverage. In health and life insurance, you can discriminate for certain things, such as age, smoking, stuff like that. But obviously, you cannot discriminate because of somebody's color or their race. The basics, like don't be a jerk, right? So, no discrimination. Misrepresentation. Don't lie about things that are material facts. So, you as a person applying for insurance cannot misstate things that you know are not true. And as an insurance agent, you can't do that either. So don't misrepresent things that are not facts. Twisting is saying things about insurance policies that are not true in order to get somebody to switch. So you are twisting the facts. Churning is a prohibited act of replacing an existing policy with a new policy for the sole purpose of earning extra commission. There's no benefit to the customer. You are just saying, get rid of this old life insurance and get this new life insurance because I'll earn a commission. And that's not allowed. Rebating is offering freebies like discounts, kicking your commission back, giving people a financial incentive to buy insurance from you is rebating. It is against the law in almost every state. Some states have a limit, like you can do up to $100, some like a little gift card or something, or a present. Other ones, it is all prohibited completely. So know the laws in your state for rebating, because it is prohibited in most states, and in all states there is nobody has to just go ahead and do it. Okay, so there's going to be either a restriction like $100 cap, or it's going to be perfectly illegal. So just know the rules in your state on rebate. Okay, more prohibited stuff. False advertising. Don't say untrue things. Don't say untrue things about yourself or untrue things about other competitors. Insurance fraud. Insurance fraud is making false claims for financial gain. There are usually more than one party involved. Don't get involved in any sort of insurance fraud. You will go to jail. And you may want to know what the laws are for your state, if there are state-specific laws for jail time in your state-specific material. Okay, that's it for the prohibited stuff, but this is still kind of a little bit like that. Controlled business. You need to know what controlled business is because most states have a limit on it. Controlled business is stuff that you control. It's your friends, your family. You'll find a lot of insurance agents sell an awful lot of insurance to their friends and family, which is perfectly okay, but it is prohibited in most states for that to be the only reason to get an insurance license. So a lot of states have a limit. Some states is 20% of how much controlled business can be part of your book of business. You cannot, in most states, have an insurance license just for the sole purpose of selling insurance to your friends and family. But you can sell to them. You just have to know that that can't be your entire business. Fiduciary. A fiduciary is a person of financial trust and responsibility. This has mostly to do with how you control premiums if you take in premiums. You can't commingle them. You're responsible for turning them over to the insurance company quickly. You're basically just behaving yourself with other people's money. So a fiduciary is a person of trust and handles others' money in an appropriate professional way. You're obviously not mixing it with your own money. Fair Credit Reporting Act, this can be on every insurance exam. It basically allows people it protects the privacy of consumers and allows consumers to dispute inaccuracies in their credit report because most insurance companies pull your credit report when they're checking you. So if there is inaccuracies there or if they're denied, they have the right to get a copy of where the insurance company got the information. So really, you just need to know for the Fair Credit Reporting Act, it protects your privacy and allows you access to correct any discrepancies in your credit report. This is one where I don't even know why it's part of the exam, but you have to know the difference between a domestic, foreign, and alien insurer. A domestic insurer is an insurance company, an insurer, incorporated in your state. Foreign insurer is not necessarily from a foreign country, it's from another state. So that's the one that they trip people up with. A foreign insurer is incorporated in a different state, not your state. And an alien insurer, like I guess you could go with being an alien. An alien insurer is one from another state, another country. So if they were an insurance company from, say, Canada, that would be an alien insurer. If you lived in Georgia, where I live, my domestic insurers would be insurance companies incorporated here. But if it was an insurance company from Texas, it would be a foreign insurer. So super confusing the way that they use that. For some reason, they want you to know that as part of your exam. I don't think that's as important as knowing a lot of the other things, but it's going to be on there, so be sure you know it. This is another one that for sure is going to be on there in some way, shape, or form. It's either going to be mutual or stock, or what's the difference between the two. So make sure you know the difference between a mutual company and a stock company. I think it's nonsense that you need to know this, but it is always on the exam. So a mutual company is owned by the policyholders, and you can receive dividends. A stock company is owned by the stockholders. So the stockholders own the company. The mutual company is owned by the policyholders. So, and just an aside, mutual companies tend to have usually sometimes better rates because they don't have Wall Street breathing down their neck. But that's an aside. But for your exam, know the difference between a mutual and a stock company, because there's going to be a question on one or the other, or what the difference is on the two. All right, that's wrapping it up. Check out some of our other videos for stuff. Also, we have free printable glossaries for property casualty exam. We also have them for the life and health exam. And since we're here and we're at the end, I'm going to give you one free bonus question. There is going to be a question on your exam that is going to say, who do you represent? And that question is always the insurance company, the insurer. It's going to ask, do you represent the customer? Do you represent yourself? Do you represent your agent? Some question along that lines. You, at the end of the day, this is an ethics question, always represent the insurance company. So be sure that you know that one, because I saw that on both my life and health exam and my property and casualty exam, and a lot of people mention that being on every single exam. So that's your free bonus question. Hopefully all of these help you pass, but check out our free printables. They have great glossaries just to get all these terms nailed down, okay? And thank you for watching. I appreciate you so much. Please like and share, and subscribe to our channel. And best of luck on your exams. Take care. Bye.